Hello, this is Prof. Aram, and in this video, I will go over an example of a balance sheet and specifically focus on three things that we need to pay attention to when we are examining a balance sheet. So let's get to it. This table shows a simplified balance sheet for a fictional firm. There are three essential things we need to pay attention to when examining a balance sheet. First of all, you need to pay attention to the order of the assets and the liabilities that we see in a balance sheet. Assets are ordered based on their liquidity, meaning that the most liquid asset is going to be on top, which is of course cash and short-term securities. And then we have accounts receivable, which is the cash you're going to collect from the customer. This is the sales that has already happened, and you wait to collect the cash from the customers. And this is the inventory, raw materials, or finished goods that you're expecting to sell very soon. So these can be turned into cash fairly fast, and then the rest of them are going to be less liquid as you go down. For example, fixed assets. A factory is not very liquid. So when you go down on the asset side of the balance sheet, the assets become less and less liquid. Now it's a good time to understand what do we mean by liquidity. Liquidity is the ability to convert an asset to cash in a timely manner without a significant loss of value. That's a very key condition. You can always sell anything that you want if you bring the price very low. But liquidity is the ability to convert an asset to cash without a significant loss of value. On the other hand, liabilities are listed in order they need to be paid off. Current liabilities are usually the firm's most immediate contractual obligations and must be paid off within a year. For example, you need to pay your suppliers first. You need to pay the interest and principal on the loan, on the short-term loan that you have within a year. These are the liabilities that their bills come due very soon, within a year. Hence, they are listed first. And next are the long-term liabilities, which are long-term loans and bonds that the company usually has. And after that, we have shareholders' equity, which is owner's equity plus common stocks and paid in surplus and retained earnings. Here we need to differentiate between debt and equity. The first difference between debt and equity that these have interest payments, interest and principal payments, right? So you need to make fixed payments on a regular basis. But for equity, there is no payment required. Some companies pay dividends, but even if they cut their dividends or stop paying dividends altogether, nothing is going to happen to the firm. It doesn't have to necessarily file for bankruptcy. But if they don't pay the interest and principal on their loans, they have to file for bankruptcy. The other one is seniority in times of trouble. So if the company, for example, files for bankruptcy, these guys, the liability holders of the company, the creditors of the company, are going to be first in line to get paid, and then whatever is left is going to be for the shareholders of the firm. That's why shareholders are usually called residual owners of the firm. And then the next or the final difference that we're going to look at here is the maturity. The liabilities usually have a maturity attached to them. There is an end date for each liability. For example, if you have a loan, the loan should have a maturity of, for example, a year or 2 years, or for long-term debt, 20 years or 30 years. But there is an end, right? There is an end date to these liabilities. That's why they have a maturity date. Whereas the shareholders' equity account, there is no maturity. As long as the company exists, these are going to exist as well, the shareholders' equity. Now, let's look at another important distinction here, and that's the difference between the book value and market value. Book value, the balance sheet values are usually book values, meaning that they are recorded based on their historical value. Market value, on the other hand, is the actual value, the price at which the assets, liabilities, or equity can be bought or sold today. Usually these two are very different, and we're going to see why. But which one do you think is more important for us for our decision-making purposes? Book values or market values? So let's dig deeper in the difference between these two. According to the US GAAP or other accounting standards around the world, the assets on the balance sheet are based on their book values or historical costs. And these assets are carried on the books at their purchase price minus the accumulated depreciation that they have, regardless of how long ago they were purchased and what they are worth today. This is less of an issue for current assets because current assets are renewed every year. But for long-term assets, this is going to be an issue, meaning that for long-term assets, for fixed assets, usually the book value and market value are significantly different. Also in finance, we are usually more interested in the firm's market value and need help finding this information in the balance sheet. Since the balance sheet assets are recorded based on historical values, there is no obvious link between the total assets in the balance sheet and the market value of them. One of the reasons that there's a significant difference between the book values and market values can be because of some of the most valuable assets of the firm, such as the expertise of the CEOs and CFOs, the talented engineers and scientists that they have, the intellectual capital they have. None of them appear on the balance sheet of the firm at all. For example, one of the most valuable assets for some firms is their brand name, but it's not reported as an asset in the balance sheet. Some believe that, for example, Coca-Cola's brand is worth over $50 billion, but you don't see that entry in the balance sheet of the firm. There are a lot of things that don't make it to the balance sheet, and that's why there is some discrepancy between the market values and book values. Also, shareholders' equity account is usually significantly different from the market value because, of course, these are the shareholders' equity account. These are based on what the owners of the company have paid over time. The retained earnings is the earnings that have been accumulated over time. It doesn't show the actual market price. The actual market price for a healthy firm is usually significantly higher than the book value of equity. I hope you find this video useful, and thanks for watching.